Good morning, traders. Thanks for joining me today on this Tuesday, the 2nd of September. Welcome to September 2025. I want to remind you that derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. It is 8:01 a.m. Chicago time. Beautiful day here in Chicago. This is episode number 2680. As you know, I was traveling last week. I did try to do a TraderBite pretty much every day, but the forces of the universe prevented it. We had a couple of good shows there. We talked about what was expected versus what we got. Today, we'll start as usual with our pre-market summary sheet from Convergent Trading. We have a strong risk-off sentiment. We've got a market that's kind of held sideways and then just drooped off, and the indices have just fallen off a cliff here this morning, pushing right through that 64.50 key test area. Last week's low, 64.44, was also taken out, and we are pushing down. You could see relative range. Look at that the RN, R vol, the relative range, relative volume columns are quite blue, which means they are really, really hot. And the percent change from settlement is relatively hot this morning. There's a flash. The EU flash inflation number came out higher, 0.2 versus 0%. Inflation rate, 2.1 versus 2% expected. And core inflation in the Eurozone at 2.3 versus 2.2. In addition to that, the U.S. Treasury Secretary Besant said he plans to write a brief for U.S. Solicitor General to file that defends U.S. Trump's tariffs. Remember, Friday, a judge struck down the tariffs as illegal, as in the U.S. president does not have the authority to blanket impose tariffs on imports. As a reminder, tariffs are paid by the consumer, that is the American consumer generally, unless the manufacturer is willing to absorb those additional costs. In other words, a manufacturer will pay the sales tax on your behalf, and most do not. So generally, they have an inflationary impact. Besant says he's confident that the Supreme Court will uphold Trump's tariffs. Putin and Modi had a summit this weekend, and it resulted in a pipeline agreement, gaslight pipeline agreement between, I believe, Russia and China. So deals are being made there. Kind of a new powerhouse is being formed there. U.S. Amazon Prime signups fell short of last year's total and target. Nestle ousts its CEO for having an affair with company employee. They must have gone to a Coldplay concert together or something. And then we have what we have for today still. We have the S&P Global Manufacturing PMI for Canada. Expected, we don't have an expectation. Well, we have a forecast 46.8, but the big number today is the ISM Manufacturing PMI out of the U.S. expecting 49. Consensus is 49. The prior is 48. This evening, we get the Australian GDP growth Q on Q expecting 0.5 and a GDP growth rate year on year out of Australia expecting 1.6. The prior is 1.3. Okay, so that's that. Looking at the S&P is in a very clear trend down. Is in a very clear trend down. Volume is exceeding what we would consider normal. You could see the overnight statistics show that the edge of one standard deviation or what we would consider normal is 220,000 contracts. We're at 228, and we still have 23 and a half minutes for that statistic to finish. The inventory is 100% short on heavy volume, so look out for that. The range is 95 points, well above the one standard deviation limit of 50 points and a point of control of 29 points for the day. So statistically speaking, we're operating in a market that is way outside what we would consider to be normal. So that's important information because it means that we've got to turn off all the distractions this morning and focus on the market action, because there will be market action here based on what's going on. So what's going on? Well, the dollar pushed up this morning. The dollar's up almost 1%. The dollar index is up almost 1%. The dollar index, as you see there, it's up 81 basis points. The dollar index is trading 236% of its relative volume at this point of the day over the last 20 sessions, and 161%. This is putting the squeeze on the British cable, euro, the Swiss, the yen, and the Australian. Also, we're seeing yields in Europe rising. This is protection. And we are also seeing the U.S. Treasury yields pushing up. And remember, the U.S. 30-year has been pushing up all along. Here's the yield chart on the 30-year on a weekly basis. Let's switch to daily here. And you can see this thing is kind of motoring up. Okay, so remember, just a little bit of macro here for you if you're interested. The Fed is being pressured into cutting rates. The Fed has a mandate to push to control inflation and for full employment. We have full employment technically, but inflation has been above the target rate of 2% for about 52 or 53 weeks, something like months. Something like that. So the Fed has not done a good job of bringing that inflation down to where it needs to be. Now, remember, inflation describes how much prices across rents, consumer products, and so on, energy, is increasing. So inflation going down just means prices are increasing at a lower rate. It doesn't mean that prices will come down, which was what's promised by this administration and hasn't happened yet. You'd need disinflation or a push down in these prices, and we're not seeing that at all. Now, some of that can factor into it coming down from where it was towards the 2%, but we're nowhere near the 2%. And so I think it's at 3.2 or something, 3.1%. And so the Fed being pressured to reduce rates actually increases inflation generally, macroeconomically. And the Fed only controls the short end. They control basically the shortest end of the yield curve. And the rest of the yield curve is controlled by those who are buying the debt, whether it's a 3-month, 6-month, 1-year, 2-year, 5-year, 7-year, 10-year, 20-year, 30-year. And that's what makes up the yield curve. And the part that market participants will take are taking the most risk on and therefore expect the most return on is the 30-year bond, the 30-year Treasury bond. And if the 30-year Treasury bond remains high, it's basically saying that you need to pay me more interest for me to loan you money for that duration. And that interest keeps going up. So there's just an indication of lesser confidence in in the economy, or not in the economy, but in spending and the control of spending. So it's worries about government finances, inflation risks, and now we're politicizing the Fed, and that's likely to create less confidence in the Fed's independence, which overall is negative for risk. So that, on top of the fact that the president of the U.S. has not made an appearance in like 3 days or something like that, 3 or 4 days, which is highly unusual, and rumors are abound, and there's weird stuff going on, video that's been captured of the White House who knows what's going on. There's so much drama and mystery and reality TV going on. This is shaking the market's overall confidence. With that, the president's expected to make an announcement at 2 p.m. Eastern today, and people are hedging their positions, right? So, kind of an odd thing. Generally, if this is concerning the president's health, and generally, when it comes to the president's health, people are entitled to know because the president controls nuclear weapons, the future of the country, and so on and so forth. So that's kind of been weird. So I think that people are coming in, given what's happened over the weekend and over the holiday yesterday, and they're taking money off the table. In that, also, gold has been pushing, and for the first time closed right up. It was closing right up against the. This is the highest that gold has ever closed, right up here. And so gold is kind of a squeeze, and it's the biggest hedge product. You can see how gold's been rallying all along for quite some time, and gold is that physical hedge against U.S. currency. It's denominated in U.S. dollars. So some weird things going on. But let's just refocus on what matters to us as traders. So let's back it up a little bit. So what I'm explaining there are kind of the inputs and some of the risks that the market is seeing right now. Remember, the market is very, very allergic to risk exposure. So wherever there is an obvious unknown in the market, the tendency is to move to safety, because your fiduciary duty and your first responsibility is towards your investors, for those who operate in the market. And so if you are doing what's best for your investors so you can stay in business and they don't withdraw your money because you're being frivolous with their money, the best thing you could do is just take some off the table or put on hedges. Futures are used for capital efficient hedging, or you just sell and then just re-enter. And so whenever there's risk introduced in the market is very, very aggressive about the market's very, very aggressive about responding to that selling. So what have we done? You can see that we popped higher here on the 22nd, right? We opened, we tested down, and we just exploded upwards. And I told you last week that, hey, this has left pretty weak structure. You can see these single prints. This is the shaded area here. Why am I so orange? The shaded area here. And so this is all weak structure, and it's likely to be weak structure all the way down into the 60. Remember, the 64.30 was important last week, and then we have the 64.12 closes this weak area, and then we're back into this 2-day balance once we get into the 63.95 zone. Guess where we're trading right now? 64.02, the low 63.87. We looked like we were about to correct this weak structure, and I prefer, if I'm bullish, I would prefer, if I'm bullish, I would prefer to have weak structure corrected and to have a good base from which the market can push up. And so having this weak structure left underneath us has a tendency of being filled in, and that's what we call in auction theory, we call that structure repair. Right? We go back and repair these structures. And the expectation is we're likely to do that for as long as these singles are here. We're likely to move back down through. So we ended up pushing a little bit higher, making new all-time highs, closing pretty strong on the all-time high. And the expectation is that we are likely to challenge that 65.23 to finish the rally, since it ended with time. But as you recall, on Friday, we ended up gapping down internally, opening basically the same place we did on Thursday. We opened on Friday. We were unable to push up at all into the point of control of Friday. You can see the point of control remains naked at 65.0375. Remember, 65.0250 represents a double top. So 65.0250, 65.0250, and we broke through it. So we poked by a tick and then pushed down into a B-shaped profile, legitimate B-shaped profile with the point of control shifting down from up here. So we've moved the point of control down. Suddenly we've turned the point of control up, and we finished with the point of control a lot higher. And as soon as the point of control comes down, again, we start to think, hey, why are buyers not able to hold prices and hold value at higher prices? This is a warning, right? And then what you see here, this little action here, is basically yesterday. You can ignore it. I cannot remove that from my chart. But currently we're trading at 64.01. And so what we've done is we've pushed through. However, the repair of that structure needs repair now. So if you look at this, we have, so I marked, this is my main chart that I watched. This is the intraday chart. This area that we came into, I talked about last week. This is where NVIDIA tested and pushed higher. Some of you might remember this zone that we have here, 66, 64, 64, 75, down into the 64, 56, 57, or 53 actually. This zone here is really important. It is the base from which the rally broke out into all-time highs, and so we'd expect the retest and hold. And we did get that. Friday we sold off. Then we popped a little bit on Sunday, came back into the zone, popped again, and then came in and retested. So this zone has basically been validated by the market very clearly. And now what we've done is we've created yet more weak structure. You have single prints in the overnight session right there. You have single prints in the overnight session right there and there. So what this is doing is it's moving the point of control down. You can see move down, create a new HVN, move down, create a new HVN, move down, create an HVN. This is a trending down market. That's those are the hallmarks of a trend. As we bring in the volume of these 2 days, you can see that volume here at 63.90, and we went to 63.87. So even though it has sold off quite a bit, not a lot of damage has been done. Okay, so how do we know that? We can look at the weekly. This is the daily. You can see the daily is just, these are important areas here that I'm always highlighting a price map in every time frame. These are important areas up here, and we are just basically moving up, pulling back. This is like a golden ratio type of pullback, like a 61 or whatever fib. And then we're looking like we're putting in another 61% fib and so on. Am I bearish now, the market? Is this market done to the upside? Absolutely not. If you look at the weeklies, we haven't accomplished much in the weeklies at all. We're just holding steady near highs. We're holding the 6,400 and the high 65.23 or whatever. So there isn't all that craziness going on. So why am I telling you this? Step back, put the chart up, go across the room, look at it from a distance so that you can gain context of what's going on. I use a 4K TV. I like to put up a chart in full 4K, compress it, fit it into, and then fit it into the frame, and then walk across the room and look at it just to gain context of what's really happening, as opposed to, for example, looking at this chart, which just absolutely tells us that we should be bearish and that a huge sell-off is happening and, oh my God, I better get on the short, whatever. That may be the case, but don't get caught up in this kind of shorter time frame. This is my trigger chart. It's only looked at once the trade has been decided on this chart. So what are we looking at for today? A lot of talking. What are we looking at for today? Let's see. Let's move to this, make your chart bigger. And then bring up our colors. So what are the most likely plays here today? The most likely plays are very wide range. We've already exceeded. Look at this. We have 2 Vola Sigma here, 2 Vola Sigma from the prior settlement. This is 1 Vola Sigma up here, 2 Vola Sigma, and then we're moving towards 3 Vola Sigma. Okay, so the probability of the market closing within 1 Vol Sigma, historical probability, is 1 sigma. Just the standard 68%, right? 68% of the time, we would expect that the market will close within 1 Vol Sigma, right in here somewhere. And then when we push into 2 Vol Sigma, 95% of the historical data says we'll close within this. 3 Vol Sigma, it's 99.3% or 99.7%. So for us to close beyond 1 Vol Sigma, that happens, right? There's a 5% chance that would happen. 2.5% per side, or nine, just consider 5%. There's a 5% historical probability that it would close in here. So what does that mean? This means that the rubber band in terms of range is really stretched right now. It's really stretched. So am I going to want to sell aggressively in the hole where we are now? No. Would I sell? Given structure and given a definition of risk on any given trade? Absolutely. The trend is down. The overall market imbalance is to the downside. I'm going to be looking for opportunities to sell. But as a professional trader, I have to sit back and go, but what's really happened? What's the context and narrative of what we've done? And what the context is that we've really stretched the bands so far. We've really pushed where we are, and in general, we are likely to close. We're likely to close within 1 Vol Sigma, so it's likely to close above 64.36 or whatever that number is. But on the outside, we would close above 6,400. Close above 6,400. A lot can happen during the day, so it's kind of stretched, but it could still continue to explore to the downside into the 63.50 or whatever, and go to the low of 2 weeks ago. Last week we're below last week's low of 64.3075 right now, and so we've broken the weekly time frame, which is really important. Breaking a weekly time frame is really important. It gets the attention of the higher time frame of the OTF, and that tells people that they need to move into caution. But any pop from here into the key support, into the prior week's low, I'm going to look for opportunities to sell for a continuation trade because we're in a trend down. Okay, so I'm looking for the market. What are we looking for this morning? I'm looking for a bounce on the open. I'm looking for the market to rebalance inventory, get back to more statistically in-line levels, come back in here into the 64.30. I'm looking for the 64.30 to be poked, fail. So we're looking for a failure to 64.30 and weakness on the retest, and we're looking for a short to grab a run at 64.10, 6400, and then whatever it gives from there, it gives. That's the primary scenario. Little rebalance, and then a continuation trade. Otherwise, the other more likely scenario is scenario 2, which is an open that pushes higher, does not get much participation, breaks the low, and then starts to move towards 3 sigma, which is not likely to happen, but then it gets held into that 63.78 or so, and then it just pokes the overnight low, and it just holds steady, and it bounces. In other words, the market has done the job in the overnight session with the participation of the European market, but now it is balanced, right? How does it do that, it does that because a bunch of people are going to come in and they're going to say, wow, oil is up 1.5%, yields are up. That's bad news. But you know what? These are bargain basement prices. We still have a tax cut. Tariffs are coming off the table, and so on and so forth. These are bargain basement prices. And so you'll have this fight between those who are needing to hedge and those who are trying to get into the market with better prices. And so we end up balancing out. The third scenario, because we are in a trend, a third scenario becomes a higher probability. The third scenario, which is our cyan color, is a market that tries to pop higher, is unable, and impulses down and just creates another impulse trade, consolidate, a continuation, and then comes back with a V bottom at the low, creates an excess somewhere down here. So I'm going to write an E with my trusty mouse here, an E for excess, and then it just comes and bounces near the lows, near this point of control from back here, this trading that happened last week. So all we did is we made new highs, came back to where there's balance, where we've balanced last to the downside, and we're going to rest. And that could create a base for another run at the point of control at 64.70 or so. Again, I know that's a lot to cover. This was a long one. There's a lot of structure here to talk about. Does this all make sense? Are you following all the acronyms, where I'm coming up with these ideas? What's the reasonable basis from which I'm looking at? What's the theoretical basis of our trade? Because that's very, very important. A real quick look at crude. Here's crude reversing already. So this is very likely to put a base underneath, the indices. We're looking then for the treasuries to also reverse, but crude has really run up in the overnight session, went right into our collision cloud and the 6600. We have a collision cloud zone right up here, went right to that, came right back off, and we are now in balance with basically yesterday's trading, which isn't much, but it's very likely to see itself back to 64.20. Crude being rejected above 6,500 again. It's trading 6,500, and it's coming right back. So this is very interesting. By the way, NASDAQ, same story as the ES, follow the same thing as the ES, same plan, same scenarios, okay? Good luck today. Be sure to like the video, subscribe to the channel, set alerts, so when we do the next video, you're able to get an alert, okay? You can do that by typing ft71.com/YouTube, lowercase, and that'll have you subscribe to the channel and to get notifications of anything that's posted. Take care, everybody.